You might have heard someone talking about investing in treasury bills, but do you really understand what they are, how they work? When you talk about 91 day, the 182 day, the 364 day, do you really understand what all these terms means? When we talk about discounted rate, when we talk about auctions, do you really understand? In this video, we are going to break treasury bills from A to Z, so that if you are interested in investing in treasury bills, you will know anything and everything that you need to understand before getting into it, because we always say don't invest in something that you don't know. Welcome to Finance Focus with Andrew, a platform where we engage in conversation that endeavor to enhance our financial literacy. In case you are coming across this channel for the first time, subscribe, turn on the notification bell so that you get notified anytime we get to post a new financial tip. And we dive direct into our topic today, which is treasury bills. And we cannot talk about features of something that we don't know, and that is why my first subtopic will always be definition. We really need to understand what are treasury bills before we even talk about the interest rate and how you get to benefit from them. Now, to define treasury bills, I will say this. As long as you are in Kenya, you will not go past 1 week without hearing someone talk about debt. That is the debt taken by the Kenyan government. Maybe in the news, maybe on the newspapers, maybe on the social media, you are likely to hear someone talk about government debt. Now, government debt, so this is government debt. Government debt is split into two major components. We have what we call the domestic debt, and we have what we call the foreign debt. Foreign debt. So, ini yenye tunasikianga ameingia ndege, tunasema ameenda kukopa. That is not our interest. We are interested in domestic debt. Now, again, when we come to domestic debt, we have two major components. So, under the domestic debt, we have what we call the treasury bonds. Then we have what we call the treasury bills. Now, we have discussed treasury bonds in this channel more than enough times. So in case you have not watched the video on treasury bonds, you can check on the same channel and you will be able to understand more about treasury bonds. But for this particular video, I want us to focus on treasury bills. So having done that, it is very easy to explain what are treasury bills, because treasury bills are short-term. That is a key term. Treasury bills are short-term debt borrowed from the public by the Kenyan government. So it is money that Kenyans are lending to the government, but on a short-term basis. We discussed about treasury bonds when we talked about long-term loans. Now, the government also wants some short loans, and they collect them in terms of treasury bills. So treasury bills are short-term loan advanced by the members of the public to the government. Now, how do we benefit from treasury bills? Now, in every loan, we say that we have two people. We have someone who is borrowing, and we have someone who is lending. And now, the Kenyan government is borrowing, and Kenyans are lending. So, the borrower will benefit, the government will benefit from getting money to execute its projects, its roles, or whatever use they get to put that money into. But the lender will get a profit in terms of interest, because whenever we talk about a loan, the word interest is not far from there. So you get to benefit from getting interest by lending the money, by lending the government money on a short-term basis. So I hope it is clear on what treasury bills are, and we can move to the next thing that we need to understand about treasury bonds. Now, let's talk about our topic number 2 there, which is term to maturity. Now, when you talk about term to maturity in treasury bills, it is very clear and very basic. We have treasury bills of 3 different maturities, just 3. And number 1 is what you will hear people call the 91 day. 91 day. Number 2, the 182 days. And number 3, we have the 364 day. So that is it. It is a short-term investment. So the longest period that we have is 364 days, which is equivalent to 1 year. The 182 days is equivalent to 6 months, and the 91 days is equivalent to 3 months. So when we are talking about treasury bills, we are talking about investments that will either last 3 months, 6 months, or 1 year, the longest. So that is it. We are talking about short-term investments. Now, that is very simple. Number 3 is also quite simple. The minimum amount that you need to invest in a treasury bill is 50,000, and any additional amount need to be a multiple of 50,000. So 50,000, 100,000, 150, 200, 250, all the way. Taxation. We talked about bonds, and we said that we have some bonds that are tax-free. When you come to treasury bills, the case is quite different. There is no treasury bills that are tax-free. All treasury bills attract a tax of 15%. So once you decide to put your money into a treasury bill, you should have it at the back of your mind that at the end of the day, you will have to pay 15% tax out of the interest that you get to earn. Now, let's go to the next topic that is quite important. That is the treasury. That is the interest rate calculation, because that is what will enable us to see what will you take home at the end of the day. What is the benefit that you get from the treasury bills? So interest calculation, and I think it is the only place that we might take maybe a few minutes, but also not quite long, because there is nothing complicated when it comes to treasury bills. And let's talk about interest rates. So interest rate calculation. I would want to start by saying that it's too unfortunate if you are learning about treasury bills in 2025, when you are talking about interest rate of 8 and 9%. Last year, a time like this, we were talking about interest of 16-15%. So it's unfortunate that maybe you never knew about treasury bills back then, so you did not enjoy the high interest rate, but it's never too late. Maybe we might go back there in some future time. Now, when you talk about interest rates, I mentioned when I was starting about something that we call discounted rate. Now, what is discounted rate? Or let me say that treasury bills pay interest. Interest rate is discounted. Or treasury bills pay interest rate in advance. How does that happen? When we are talking about treasury bonds, we said about you invest and then you wait for the interest. But for treasury bills, the case is quite different. They are sold at a discount. For a good understanding, wacha tuachane na story mingi, and we go direct to the point and do some calculations so that you understand when we say treasury bills interest is discounted, or treasury bills are sold at a discount. Now, let's assume I want to invest 100,000 in the 364-day treasury bills. So I want to invest 100,000 in the 364 days. That is the 1 year treasury bill, and we will use the latest interest rate. That is last week's interest rates which was for 364 days. The interest rate was 9.5734%. So this is the interest rate, and I want to invest 100,000. The formula for interest will always be the same: principal times rate times time. Now, so our interest will be the principal, which is 100,000. We multiply by the rate, that is 9.5734. divided by 100, and time is just 1 because the time period is 1 year. So, but you need to factor in the element of time when you go to the 182 days and the 91 days. Now, this automatically gives us 95.73. So this is the interest that we get at the end of the 1 year. But remember we said that treasury bills are subject to withholding tax. So a 15% out of this amount does not belong to you. It belongs to KRA. Now 15% times 95.73. I believe that comes to 1435. 1435. Now, the total interest was 95.73, but an amount that is 1435 does not belong to us. So our net interest will be 95.73. We subtract 1435. And that comes to 81.38. 81.38 is the interest that we are entitled to at the end of the year, or it is the interest that we get from an investment of 100,000 in our 364 days treasury bill at 9.5734%. Now, the investment that majority of us are used to, this is what would happen. Now, there is now, and there is 1 year. After 1 year, so the kind of investment that we are normally used to, so this is the normal investment. What you will do is that you would give 100,000 right now, and at the end of the 1 year, you would get 108,138. This is the kind of investment that a lot of people are used to. True or true? Now, when it comes to treasury bills, it is different, and that is where the point of discounting comes in. Now, for treasury bills, what gets to happen is that what we will do now, instead of sending 100,000 to the Central Bank of Kenya, and there is an interest of 81.38, what we do is that we will send 91, we will send 100,000 less the interest that we are entitled in, 81.38. So we will send 91,862 to the Central Bank of Kenya now. Then after 1 year, it is when you'll get back 100,000. So I hope you get the difference. In this case, we send 100 and get back 108. But when it comes to treasury bills, we send the principal less the interest, so that at the end of 1 year, we get back our principal. And that is why we say treasury bills are sold at a discount. So that is what happens in a treasury bill. Ni kama unaachiwa interest yako at the point of investing. Now, the last thing that I would want to talk about is the investment process itself. It is good to inform you that while in treasury bonds you have to wait until the government floats a treasury bond. In treasury bonds you have to wait for the government to float maybe once in a month or anytime like they want to. When it comes to treasury bills, treasury bills are floated on a weekly basis. That is a must. That is guaranteed. You are assured that every week there are 3 treasury bills that will be floated in the market. That is the 91 day, the 182 days, and the 364 days. So you don't have to wait for a long time for you to get to invest in treasury bills, because you have an opportunity each and every other week. Now, the investment process is very simple. Get the DAO CSD app, open a CSD account, wait for the get the treasury bills that are floated for that week actually. Place a bid, the bid is successful, transfer the money to the Central Bank of Kenya, and in whatever period, they said 3 months, 6 months, or 1 year, you'll have back your money. So the process is quite simple, and you can be free to try it. It is a short-term investment, so you don't have to worry about a lot of things, because 3 months is quite a short time hata hutajua ikiisha. So that is it for the treasury bills. In case you have any other question, drop it in the comment section and be sure that we will be able to address it.